Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. Venture Catalyst has raised 150 crore rupees through a mix of primary and secondary shares, valuing it at $200 million. The funds will help expand teams, launch new funds and develop AI tools. New investors include Ashish Kacholia, Shah Rukh Khan's family office and Aishwarya Rai.
True Frost and Butler, a provider of commercial refrigeration and food service equipment, has raised $7 million in growth funding from Carbidine Capital. The proceeds will be used to enhance customer experience by strengthening order fulfillment, expanding service infrastructure, boosting domestic manufacturing, and exploring international markets.
Oyo is no longer Oyo. The parent company of the hospitality chain has rebranded itself as Prism, a move it says reflects its global portfolio and premium positioning. The rebrand works first major corporate identity shift for Oyo since its founding and ahead of its expected IPO filing in November.
Cloud-based cybersecurity firm Netskope is seeking a valuation of up to $6.5 billion in its initial public offering in the United States. Netskope said that it would sell 47.8 million shares, priced between $15 and $17 a piece, to raise as much as $813 million.
Meta is reportedly hiring contractors in the United States at rates of up to 4,850 rupees per hour to develop Hindi language AI chatbots designed for Indian users. These roles are part of Meta's larger plan to expand its AI presence in fast-growing markets like India, Indonesia, and Mexico, according to a Business Insider report. PhysicsWallah has filed its DRHP, eyeing a 3,820 crore rupee IPO. The edtech unicorn, founded by Alak Pandey, is betting on its hybrid model and 2 million strong student base to make a splash on the Lal Street. Rachna Dhanrajani had first reported this on December 30th, and she joins us now with all of those details. Rachna?
India's edtech story is entering a new chapter, with PhysicsWallah filing papers for 3,820 crore rupee IPO. This makes it the first Indian edtech unicorn to go public, and unlike most venture-backed startups, it will debut with over 80% promoter holding intact. We had first reported about the edtech company's IPO plans back in December, and now confirming it, we have the updated DRHP that the company filed over the weekend. Now, the offer size breaks down into a 3,100 crore rupee fresh issue and a 720 crore rupee offer for sale. Both the founders, Alak Pandey and Pratik Boop, are set to dilute a small portion of their holdings, about 360 crore each. While the bulk of the proceeds will go directly into the company's expansion strategy, that is increasingly offline first. PhysicsWallah began in 2016, as we know it, with a YouTube channel and a teacher-led digital model. But today, its offline network has surged from just 28 centers in FY23 to nearly 200 in FY25. Revenues reflect this pivot. Offline income jumped more than 4 times in 2 years to 1,350 crore rupees, nearly on par with 1,404 that was earned via online. Now, the company plans to deploy the IPO funds in line with this hybrid model. Nearly 460 crore rupees have been earmarked for new centers and about 548 crore for lease costs, about 470 crore rupees for investments and acquisitions in subsidiaries such as Xylem Learning and Utkarsh Classes. Now, all of this comes at a time when India's edtech story was a bit shaken. So there is clearly a financial turnaround story that we also saw with PhysicsWallah. Revenue was at about 2,886 crore rupees, while the losses narrowed to 240 crore rupees compared to a massive 1,127 crore rupees in the previous year. The company has also moved into positive net worth and cut debt, which is crucial marker in the edtech sector, where many peers are still struggling, as we just spoke about them. Now, for years, PhysicsWallah had celebrated being the only profitable edtech, but profitability slipped last year. Some of this was due to accounting changes, but operational costs, especially from offline expansion, that have also weighed in on the margins. The attrition rate has also been high for over 2 years. Now, competition from entrenched offline giants like Akash and Alan did not come in pretty well for PhysicsWallah, especially in the test prep and training segment where they are. Will this now all of this will lead to pressure on growth, or how will they come out and as they debut on the D Street are some things that we will be closely watching for, as it's not just for the company but also for the startup ecosystem together.
Well, thank you, Rachna, for those details on PhysicsWallah's IPO, also on what's brewing, from building a content to commerce brand to now reimagining startup acceleration with AI. Darpan Sanghvi has launched a new venture co-founder Circle, an AI-native acceleration platform for startups and MSMEs. Co-founder Circle claims it's bringing together community, capital and AI all under one roof. Darpan Sanghvi joins us now to talk about his latest bet, the lessons from the Good Glam Group and how he plans to make entrepreneurship more accessible. Darpan, welcome back to Startup Street. You've said that this platform is designed so founders don't lose focus, control or their moral compass. Darpan, was that shaped by your own experience of hyper-scaling at the Good Glam Group?
I've talked about this, I wrote about it as well, that I felt that, at Good Glam, when I reflected back, I think I did not realize when momentum became the momentum trap, right? See, it's, we as entrepreneurs are striving for momentum, that right time when everything is going correctly and you can compound things, right? That was the time for me in 2021 when we did those 10, 11 acquisitions, we did those 4 back-to-back fundraisers.
Yes.
But when to pull back, stop, consolidate, and focus on that rather than continuing to acquire more, which is what I was trying in 22 as well, right? And which, which is one of the reasons that led to eventually what ended up happening at Good Glam Group. So I think at Co-Founder Circle, one very big important piece of Co-Founder Circle is mentorship and incubation by people who've been there, done that, to startups who are just coming up.
All right. You spoke about the Good Glam Group. It no longer operates as a house of brands and is selling assets individually. Darpan, you've spoken about ensuring restitution as well, setting up a fund for employees, for vendors and shareholders. What is the update on that front?
So we have, as we launched, Co-Founder Circle was the first step towards it, right? For me to be able to create any kind of value back, I need to start something. Unless I don't start something, how will I create value? And with that value, how can only with that value can I start creating that restitution fund? So our stakeholders and our employees have been informed about this. The day we announced Co-Founder Circle, we are setting up. We've told everyone that post the announcement, between 4 to 6 weeks of the announcement, everybody will get their respective instruments, which will give them that piece of Co-Founder Circle. Which, if Co-Founder Circle succeeds, they are able to see some of that back as well.
Okay, you've also pledged, Darpan, 50% of Co-Founder Circle's equity to employees, ecosystem members, and even ex-stakeholder of Good Glam Group. Elaborate on this approach.
So I think, it stems from 2 reasons. One is, what happened at Good Glam Group, and I really want to find a way to make it whole to all my previous stakeholders at Good Glam Group. And 2, if you see what Co-Founder Circle stands for, it is, making entrepreneurship accessible for all, making the community a part of everyone's entrepreneurial journey. So what we did was that on day 0, Co-Founder Circle, 50% of the equity of Co-Founder Circle through different instruments is distributed amongst ex-Good Glam stakeholders, team members at Co-Founder Circle, and even my ex-Good Glam employees who had vested ESOPs. And the ecosystem on Co-Founder Circle that's going to mentor, incubate, and propel startups so that everybody's excited. And if you also saw, we talked about where 100% of free cash flow, over 20% PAT will go into reinvesting in the startups. All of this, I'm hoping, is going to fuel a flywheel where the community itself is promoting entrepreneurship, and it's all self-sustaining, and it's not just a one-time thing, so that people are more incentivized to help others on Co-Founder Circle because they get part of their equity that's being distributed. And then when Co-Founder Circle is making money, so people are doing deals on Co-Founder Circle. And so when Co-Founder Circle makes money, that money goes back in reinvesting in startups. So the flywheel is sort of fueling and funding itself.
Okay. Darpan, but looking back, do you feel the House of Brands model was flawed for India, or the Good Glam Group's, shutting shop was more about timing and execution?
Shruti, I've really reflected. As you can imagine, I've spent so many nights thinking about what went wrong, what I could have done differently. Obviously, it was extremely, extremely hard, right? I think, look, if you look at giants like L'Oreal, Unilever, they're all House of Brands. House of Brands has existed. I think what went wrong was we were too early to do a House of Brand. We should have first had one massive brand doing 1,000, 1,500 crore in revenue, all systems and processes well set, right? That brand generating cash flow, no more learning curves. We were still learning on the first brand when I went and made so many acquisitions, right? So I think house of brands, I think you just have to do it after you've reached a certain scale. Your systems, processes, people, everything is well established and set. And then you can integrate more brands and try to scale them up with that approach that had worked really, really well for your first brand. So I'd say that was probably the biggest issue on House of Brands, that that none of us had that one large brand, and we were all startups, right? We should have been established for maybe 5, 7, 10 years of stable growth with profitability before embarking on House of Brands.
Absolutely. So those are the learnings. But Darpan, going back to co-founder circle, one final question. Like you mentioned, it is an AI native acceleration platform, and you've built RACE, which is research, advisory, connection, execution, AI stack. How is this different from traditional accelerator or incubator models that startups are already familiar with?
Traditional incubators and traditional accelerators are closed models. You apply, you enter that accelerator and that incubator, and then only a set number of startups are able to work within that accelerator. What we're doing at Co-Founder Circle is we've created a platform that enables people to incubate and accelerate. While Co-Founder Circle will do its own set of incubation and acceleration for startups in different categories, other incubators, other startups, other mentors will be able to use our platforms to run their own cohorts of startups for their own incubation and acceleration. The RACE AI stack that you talked about powers all of this. RACE, as you said, stands for Research, Advisory, Connection, Execution. We as entrepreneurs, what we need the most is, in addition to information, how do we turn that information into outcomes? That is what RACE does. So when you go as an entrepreneur and you pose your problem, whether it's an idea that's turning into a startup or whether you're already running something and you want to scale it, RACE will pull out the right data, advise you on strategy, but more importantly, connect you to the right people, the right partners, the right mentors, the right investors, and help you execute that with the right AI tools over there. Extremely ambitious, but we're confident we can pull it off.
All right, Darpan, you've also committed that 100% of free cash flow, above 20% profit after tax, will go back into startups on the platform. Is this a signal that Co-Founder Circle will not just be about scale, but mostly about sustainability?
I completely agree. It puts our focus on ensuring that we're hitting profitability, because that number is so ahead in front of us that another mistake that I made while at Good Glam, where we were focused more on growth and not on profitability. Here we want to be focused on profitability from day one. And what we want to do is, come be a part of Co-Founder Circle, whether you're a partner, whether you're a person, whether you're an investor, whether you're a mentor, right? And then as Co-Founder Circle becomes profitable, that free cash flow goes back into startups on the platform. So the startups become the biggest beneficiary, first of incubation and acceleration, and then from the funding that comes directly from Co-Founder Circle. If we are able to create this virtuous cycle, then absolutely it's incredibly sustainable.
And on that note, I'll have to wrap up our conversation. Many thanks for joining us on Startup Street, and wish you the very best with Co-Founder Circle.
On that note, moving on to Investor Eye, India's venture capital landscape just got a boost. Elev8 Venture Partners, backed by venture capitalists, has closed its maiden fund at 1,400 crore rupees, or $160 million. The fund has drawn in big money from sovereign funds, global institutions, family offices, and even unicorn founders, underscoring the conviction in Elev8's strategy. Already, a third of the corpus has been deployed into firms like AstroTalk, IDFI, Smallcase, Porter, and SnapMint. The rest will be invested over the next 12 to 18 months in high-growth businesses. Elev8 says it's betting on profitability, resilience, and scale, backing India's next generation of market leaders. And joining me now to discuss that further is the managing partner at Elev8 Venture Partners, Naveen Honagudi. Naveen, thank you so much for taking time out and being here with us on Startup Street. Let me start by asking you, despite a global fundraising slowdown, Elev8 has raised 1,400 crore rupees, right? If you could sort of outline what factors help you close such a large maiden fund in this environment, and, what are investors saying about the startup ecosystem in India?
Yeah, firstly, thank you so much for having me over. I think one of the main reasons why we ended up closing such a large fund, probably the largest for any maiden fund in India, was largely due to our strategy. Our focus on investing into growth stage companies and focus on profitability, right? If you look at it in India today, the entire ecosystem of funding is like an hourglass. There are a lot of investors at an early stage, very few in growth stage, and then it increases significantly at late stage. And that growth stage is what we are capturing, essentially looking to invest in companies with $100 to $300 million of valuation and investing anywhere between $10 to $30 million. Back in 21-22, this was an overcrowded space, but currently it's completely empty. None of the large global investors are investing in this space, which leaves a huge opportunity for homegrown growth stage fund managers like us to invest.
Sure, so leaving a big opportunity here. But, you've already invested about 1/3 of the corpus into 5 companies. If you could sort of tell us what made you bet on these specific companies and how do you plan to deploy the remaining 2/3 over the next 12 to 18 months?
So each of these founding companies have been around. Our youngest company is probably 2017 born. Our oldest company is probably 2012 born. So these founders have been there. They've executed on that strategy for anywhere between 7 to 10 years before we've ended up investing. They've seen the worst during the COVID time. They've figured out that profitability is freedom. And we end up investing only in profitable companies. They've seen near-death situations for at least 3 to 4 times. So all of this has made the founder extremely resilient at the time of our investment. Clearly, we are nowhere close to the 21 market. We've seen companies who've grown 4x, 5x since 21, and these are probably the best companies in India. But the valuations have probably jumped anywhere between 30 to 50%, right? This provides an excellent vintage for us to pick and choose the companies that we want to invest in at the growth stage.
Sure, and if you could quickly tell me, you've said profitability a few times right now, so you emphasize profitability, resilience, and scale, right? So how do you sort of balance growth with profitability when evaluating potential investments? Also, if you could outline, the check sizes of these investments.
Yeah, so that was a misnomer 3-4 years back, right? Wherein there was a trade-off between growth and profitability, but that's not true. If you end up speaking to entrepreneurs today, which I was just looking at your news, right? I mean, PhysicsWallah, they've been growing extremely well and they're getting to profitability as well. So founders are no longer seeing this as a trade-off. Our portfolio company has been growing at about 50% year on year, given the large market opportunities that they are targeting, right? You had asked me another question about what's the forecast for us for the next 18 months. The intent is to make about 12 to 14 investments, probably another 7 to 8. So we will be deploying at about 4 to 5 investments a year. That sort of speed is where we'll be looking to invest.
So 4 to 5 investments a year. Now, your companies are reportedly growing at 30% annually while also remaining profitable. What's the common thread among these companies that fits Elev8's thesis? And if you could also tell me the sectors that are on your radar.
Sure. So we look at investing only in technology-enabled businesses. 3 broad sectors: consumer internet, fintech, and enterprise software. So each of our 5 companies that we've invested, and even companies going forward, will end up being in one of these 3 broad sectors. In terms of focus or common themes that are there between our startups, beyond being profitable and growing at 50% year on year, these companies have had existing institutional investors. Just from a signaling perspective, it helps, given corporate governance would largely not be a challenge in any of these portfolio companies. So our portfolio companies is backed by marquee investors such as Tiger Global, Sequoia, and so on and so forth. We don't look at investing into companies which have significant binary risk, which takes off, gaming, social network, and so on and so forth under this. So, and of course, looking at investing into founders who've been there for at least 8 to 12 years, and more importantly, are number 1 and number 2 in their category. So these are the large 4 or 5 themes that runs across all our 5 portfolio companies, and that's what we look at while investing in the future as well.
So that's your investment thesis going forward. All right, Naveen, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best going forward.
Thank you so much for having me over. Thank you.
Well, with that, it's time for us to head into a short break. Coming up on the other side, e-commerce player Amazon is preparing for its annual mega event, the Great Indian Festival. Over 17 lakh sellers is set to offer 40 lakh products to the customers. We speak to Amazon India's head, Sameer Kumar, on the other side. Welcome back to Startup Street. E-commerce player Amazon is preparing for its annual mega event, the Great Indian Festival. Over 17 lakh sellers are set to offer 40 lakh products to customers, and the timing of the sale coincides with the big GST reforms. Amazon India's head, Sameer Kumar, believes this will be a big boost for sellers and customers. Listen in.
GST is just a boost. It's an additional boost that the government has given to both our sellers and our customers. So our sellers are excited as well because it also simplifies their life in terms of listing products on Amazon and not having to register in multiple cities or multiple states. And for our customers, the rate change is going to be really, really exciting. So, but we have been preparing for this festival for a long time, right? Like since we ended our last year festival, we got into the mode of getting ready for the next one. So we have 1.7 million sellers who will be selling with us. Sure. We invested 2,000 crores in our infrastructure, so we are ready for all the products that are going to come in. So that means we are also improving, like 50% of our cities are going to get same-day delivery instead of, they didn't get it last year. Similarly, even more cities are going to get next-day delivery on a very last set of products. So 40 lakhs product or 4 million products will be available for next day. 1 million product or 1 lakh product, 10 lakh product will be available for same-day delivery. And so we are excited about that. Along with that, we have going to have really great bank offers, including no-cost AMI, Amazon Pay Later, all the payment products that we have. So people can afford the product and buy big tech. So if you have a need for whether it's kitchen stuff that you're going to buy for Dhanteras or you're buying apparel and shoes for the festive season, we are ready for all of that. And then along with that, we also have our quick commerce offering. Amazon Now is ramping up in Delhi and Bangalore, and I'm excited about that. It's a big change, like when you cut some of the slabs from 28 to 18% and from 18 to 5 or 12 to 5%, definitely customers are going to see a big boost. And we are also working with our sellers to ensure that the sellers are passing on the saving back to the customer. So sellers are excited about getting bigger sales, and we hope that will result in them passing on the benefit to our customer. And when you lower prices, we tend to get bigger volume. So it's funny, but we are looking forward to that.
How are plans panning out? We heard from Bengaluru, now in Delhi. What are your plans going forward as far as quick commerce?
I think it's Delhi NCR. So we are not just doing Delhi, but it's also Gurgaon, Noida, Faridabad. Some of the adjoining areas are also included in that. We were first 4 months, we were testing things and making sure we got the experience right in Bengaluru. And since then, we are in a hyper mode to keep expanding. And it's all about, as soon as our micro-fulfillment center is ready in a neighborhood, we light it up. And so hopefully in the coming days and weeks, you will see, we'll blanket Delhi NCR as well as Bengaluru. And stay tuned, we have much, much bigger plan for rest of the year and next year.
Consumer growth fund Venturi Partners has announced the first close of its second fund at $150 million, which is going to back high-growth consumer brands across India and Southeast Asia. It is targeting a corpus of $225 million by June of next year and will back disruptive, purpose-driven brands across these markets that are positioned to benefit from structural tailwinds, including rising consumer spending and favorable demographics. It is going to make initial investments of $15 to $40 million. For more on this and their investment thesis, I have with me Rishika Chandan, the managing partner of Venturi Partners. Rishika, thanks so much for your time here on CNBC-TV18. Venture capital fundraising is picking up after a bit of a lull in India. Start by telling us, of course, about your investment thesis and what really got your investors to commit this $150 million.
That means that we typically invest in companies from Series B to Series D. Check sizes ranging from $15 to $40 million. And we invest only in consumer brands across different subsegments in India and Southeast Asia. I would say 70% India and up to 30% in Southeast Asia. In terms of why investors have sort of supported us again with respect to Fund 2, I think the reason is a couple of things. One is India and Southeast Asia together are about 30% of the world's population and therefore consumer markets. These are also markets that are growing at the fastest clip when you compare it to other geographies. And then that coupled with the fact that, just the average consumer age in India and Southeast Asia ranges anywhere from 25 to 29 years. These markets are just ripe for disruption of brands. Most sort of segments that you look at across, are largely unorganized. And given the rising awareness and digital exposure that consumers have, they all want brands, and there just isn't enough availability of those in these markets. And I think our investors recognize that. Also, our Fund 1 portfolio, has been doing very well.
Well, Venturi is emphasizing this purpose-driven brand and structural consumer tailwinds, but what really defines this purpose-driven brand in your investment lens, and what kind of returns will that translate into?
Yeah, so when we say purpose-driven brands, right, what we mean is really brands that do good for the consumer, either by giving them a better product or service for the same price point, or being able to deliver more value to the customer. So, for example, we have an investment in Southeast Asia, which is a hard discounter, whose mandate is to really be able to offer consumers the same products that they would buy from any other retail outlet at probably 30-40% cheaper. In terms of returns, I would say because we're a growth investor, we look for returns from anywhere from, call it 2.5 to 4 times MOIC on our capital.
So your plan is that the Fund 2 is going to invest $15 to $40 million across 10 companies. What are these 10 companies? How soon are you going to start investing? Have you already identified some?
Absolutely. So we're actually close to investing in one company. I think we should announce that in, call it the next week or 2 weeks. And we're already in term sheet stage on our second investment from Fund 2. So we've definitely started deploying. We continue to look actively at different sectors in India, whether it's ranging from elderly care, pet care, new food and beverage products and services, so on and so forth.
Okay, so no names there, but the final close of $225 million by June, is that on track? And could you exceed this amount too?
Yeah, look, in terms of timeline, we expect to get to the final close of 225, like you said, by June 26. We have a hard cap of 250. Now, whether we get to that or not is really a function of where the markets are. And you're more than aware of the volatility, but we feel very confident to get to at least $225 million.
You also mentioned a 1:1 co-investment option alongside Fund 2. Now, how does this structure really benefit LPs and founders, and how does it give Venturi an edge when it comes to winning deals?
Yeah. So look, from Venturi's perspective, right, it gives us a lot of flexibility in check size. And that's why I said $15 to $40 million, because the fund can invest up to $20 million and the balance comes through our co-investment pool. So the advantage of that is that not only can we get access to better and high quality growth companies and lead rounds, but we also always necessarily need a board seat. And sometimes you need to get to the $40-50 million check size to get to a board seat. So that is how we sort of, can help founders by just being able to have flexibility on check size, do more follow-on rounds. From an LP's perspective, right, if you think about the co-investment pool, the 1:1 allows them to also directly access the company if they feel that it is in a space that is directly relevant to them. There are also more favorable economics on the co-investment side. And when you club that together with the fund, effectively, it means lower management fees for them.